This video is your guide to the Bank of England base rate, covering what the Bank of England does, what the base rate is, and why it changes. Take a look. The Bank of England is the UK's central bank. A central bank is a bank that looks after all the other banks in the UK and keeps an eye on the UK economy. The Bank of England is responsible for producing banknotes, supervising payment services, helping other banks make large transfers, and helping to keep the UK financial system stable. It's also responsible for setting the main interest rate in the UK. This is what's known as the Bank of England bank rate, or base rate. Interest is like a fee banks charge for lending you money. For example, when you take out a mortgage, you will have to pay back the amount you borrowed plus interest charges set by the bank. Interest rates are calculated as a percentage over a year-long period. The base rate is what the Bank of England will charge other regular banks, like Lloyds or NatWest, for borrowing money from them. Because of this, the base rate tends to influence where other lenders set their interest rates. When the base rate goes up, for example, you'll typically see things like savings rates, mortgage rates, and loan rates go up as well, and vice versa when the base rate goes down. Lenders don't have to put their interest rates up if the base rate goes up, but because an increase in the base rate means the cost of borrowing money from the Bank of England has gone up, lenders typically do put their rates up. One of the biggest jobs the Bank of England has is to keep the UK's financial system ticking along nicely and protect the value of our money. This typically means keeping prices stable, or where that's not possible, keeping price increases low, slow, and manageable. To measure these price rises, we use something called an inflation rate. The inflation rate is calculated by creating a hypothetical shopping basket of everyday items, which could be anything from a loaf of bread to a car. Each month, the Office of National Statistics reviews the cost of that basket to see if prices have gone up and by how much. This is the inflation rate. When the inflation rate goes up, the same basket that might have cost, let's say, 50 quid, now costs 60. Why am I telling you all this? When inflation is particularly high, the base rate can be a useful tool to help bring it down. When the Bank of England puts their base rate up, it's not just doing it for the sake of it. It actually aims to trigger the following series of events. Raising the base rate should influence other banks and lenders to increase their interest rates. Higher interest rates tend to mean people have less disposable income. Less disposable income leads to less spending. Less spending means businesses will be forced to lower their prices, and lower prices should lead to a lower inflation rate. When the Bank of England raises its base rate, it will often do so in small amounts over a long period of time, rather than just whacking it up overnight. It can be frustrating to watch it go up bit by bit, but the reason they do this is actually to protect the economy. If the Bank of England whacked the base rate up too high too quick, it could potentially trigger a recession. So instead, it goes for a slow and steady approach. The base rate is the interest rate charged by the Bank of England when they lend out money to other banks. It's also a useful tool to help combat rising inflation. For more information about the base rate, including predictions from our expert panel, check out our guide on finder.com by clicking this link here. If you found this video helpful, give us some love below, subscribe, and hit that bell button to be the first to know when a new video drops. Thanks for watching.